So let us start with the numerical question. Consider following information. Current value of the portfolio is rupees 5 lakhs. Beta of the portfolio is 2. Futures index value is 1000. Lot size is 50. What will be the percentage change in the value of the portfolio if the market return reduces by 10%? That is the first question. So please answer, that is a write down answer for the first question. Calculation of percentage change in RJ with percentage change in RM. Beta measures percentage change in RJ with percentage change in RM. So percentage change in RJ is equal to beta into percentage change in RM. What is beta? Beta is 2. Percentage change in RM is given to us as negative 10%. So percentage change in RJ is negative 20%. Next question. What is the amount of the short position required in index futures trading if the market is likely to fall by 10%? Answer for the second question. In that write down, we can see that, comma, investor has a long position in cash market, B, investment made in a portfolio having positive beta, full stop. So for the purpose of hedging, comma, short position is required to be entered upon. Full stop. Further write down in that, information is not given about required beta, comma, so we assume that required beta is 0. Full stop. With paragraph write down, amount of short position required. So on one side I am writing loss in existing portfolio, to be compensated with profit in futures. In bracket I am writing index, that is profit in index futures. So what is the loss in the existing portfolio? We understand that, say 5 lakhs into negative 10% into 2. This is the loss which we are expecting, which we want to cover with a profit in index, that is x into negative 10%. Because when the market will fall, you will be able to make a gain. So now x will be found as balancing figure. So it is 5 lakhs into 10% into 2, that is negative 1 lakh, divided by negative 10%, that comes to rupees 10 lakhs. This is the way we can make the calculation of answer. Next question. How many futures contracts are supposed to be sold? That is the question. So the futures index value is 1000 and lot size is 5050. So we can say answer for the third question like this. Number of contracts to be sold. In that, contract and amount. If you enter into one contract, it is deemed that the transaction is entered upon for 50,000. So it is 50 into 1000. So this is the number of contracts to be entered upon for the transaction of rupees 10 lakhs. So the final answer will be 10 lakhs into 1. That is going to remain 10 lakhs upon 50,000. So in that case, the answer is 20 contracts. This is the logical method based on the working that we already have done it, or otherwise we can do working like this also. Value of the portfolio into beta of the portfolio minus beta required divided by futures index value into lot size. What is the value of the portfolio? It is an amount of 5 lakhs. Beta is 2, beta required is 0. Whole divided by 1000 into 50. So that comes to an amount of 10 lakhs divided by an amount of rupees 50,000. That comes to 2020 contracts. This is the number of contracts to be entered upon. Now friends, at this point of time the answer is over. So only for the purpose of understanding, we are preparing one more working to substantiate that whatever the hedging transaction in which we have entered upon, so that is really making sense or not. So this is only for understanding. Calculation of overall profit or loss if market declines by 10% as per expectation. So in that we will have the working like this: portfolio an index. The transaction is entered upon for sale value. We understand that say 20 contracts are entered upon. Lot size is 50,000. So it is 1000 into 5050 into 20 contracts have been entered upon. So it comes to an amount of 10 lakhs. There is a fall in the market. So purchase value, it is 10 lakhs minus 10 percentage. That comes to rupees 9 lakhs. So profit or loss, there is a profit of 1 lakh. Okay. This is in case of index. In case of the portfolio, what will happen? Let us see. The current value of the portfolio is 5 lakhs. Now when the market is declining by 10%, value of your portfolio will fall down by 20%. So 5 lakhs minus 20%, it will be 4 lakhs. So there will be a loss of 1 lakh. So overall, you will have no profit, no loss. This is the way you can see that so you are completely hedged. Whatever the loss that you have in your existing portfolio is compensated with the profit in index. This is only for understanding purpose. You may write, you may not write, as you wish. So let us have a summary of the working that we did. The first question is very simple. Computation of the percentage change in the return of your portfolio, percentage change in the value of your portfolio with change in the market portfolio return. Then second is the transaction for entering into the short position. For that, say the logical working, and at the same time, say in the third question, number of contracts to be entered upon, for which you can apply a formula for the purpose of doing answer. And finally, a kind of cross verification that say your risk is completely nullified if at all you are entering into the transaction like this. This is the way we can write the answer.